Hello everyone, we're going to talk about self-funding, which is another option we have here, self-funding and DPC. So when we're talking about healthcare, we actually have three very important healthcare considerations. We have to look at the patient and the employee, we have to look at the physician, we have to look at the business and employer. For time's sake, we're going to jump right to the business employer. What the business employer has to look at is what are the options for providing a qualified plan. You know, under the ACA requirements, every business has, if they offer health insurance, they have to offer a qualified plan. And what is the employee coverage going to look like under that employee plan? The employer plan. The problem is that you have new employees that are going to come in. This has to be something that's attractive to new hires. So, and also your current employees. So what is that plan going to look like? And what is the plan going to cost? That is an ultimate concern for the employer. And I'll show you in a minute. Group health plan options, traditional. This is the traditional model that most employers go with. Cigna, United, Blue Cross, those are your traditional plans. And what it is it's a fully insured plan. It's the traditional way to offer employer-sponsored health care. And with a fully insured health plan, the company pays a premium to an insurance carrier and they take on the risk. So any claim that comes in for that employee is paid by the insurance company. The insurance carrier assumes all risk for future claims. 17% of small employers choose this option. And it's not cheap. The average annual premium for single coverage is over $6,500, and for family coverage it's more than $17,000. So we're talking a lot of money here for an employer. And why is it so expensive? The reason it's so expensive is because qualified health plans must offer essential health benefits. Essential health benefits are those 10 items that the ACA requires every insurance plan to offer. Stuff like maternity care, whether you're male or female. And they pay a premium tax. Every employer that offers a fully insured plan has to pay a premium tax on that plan. So, what is our option? We have self-insured or self-funded. They both mean the same thing. So a self-insured or self-funded plan means the employer is taking on the risk for all the claims of their employees. The employer is the owner of their plan. They actually create and write their own plan. And the claims are 100% funded by the employer. Okay? That may seem like a risky transaction to get into. However, in 2015, 63% of all workers, regardless of employer size, and 83% of large employers were covered by self-funded plans. Most employees are covered by self-funded plans and they're not even aware of it because it looks exactly the same as a traditional insurance. So why would so many employers choose self-insuring? Potentially much lower cost due to the employer designs the plan. The employer can actually sit down with a third-party administrator, which is the entity that designs the plan, and decide what they want to offer. No essential health benefits. An employer that self-funds does not have to offer qualified health. They don't have to offer essential health benefits. So they can set their own deductible, they can set the copay, they set the plan. There's no premium tax. And there's protection via stop loss. What stop loss is, and you can do this for an individual or you can do it for a group, is you set a maximum risk. So say you're going to do $100,000 on an individual. So if you have one individual that has a catastrophic event, they have a massive heart attack and wind up in ICU. The employer is only on the hook for that first $100,000. After that, the stop loss kicks in and they take over. And you can also do this as a group. So if you have a group of employees, you can set a certain risk, and that's as far as the employer is responsible, and then the stop loss kicks in. So how does self-funding work? So we're going to look at this is an actual real scenario of 112 enrolled employees during a mature plan year, meaning they've been in self-funding for a while. So the total premium paid by the employer was $970,000 for 112 people. And this is what it looked like. So the actual claims, the actual amount that was worked on, or the medical claims by the employees, was $690,000. Okay? So what happened to that other $280,000? That went to the insurance company as profit. So if we look at self-funded, you have claims here. You still have your $690,000 here for your claims, and then you've got your TPA, your third-party administrator cost is $30,000 here. Your stop loss, which is extremely important, is $130,000. You have $120,000 in savings just by doing this. So your premium went from $970,000 to $850,000, a savings of 12%. Okay, so the most important thing with self-funding, we just talked about claims, medical claims. The most important thing is to control your claims. How do you do that? You use free market solutions that include direct primary care, like Dr. Savage just spoke about. By using DPC and cash-based providers, employers can save a minimum of 30%. We're talking actually more like 50 to 60%. So let's look at a chest pain office visit. So if you were to go to an urgent care, or, well, it'd be even more if you went to an ER, or to a physician's office, you're looking at an office visit, an EKG, chest x-ray, CBC, troponin, CKMB, all these labs, injections, and all that, and your total cost for that is going to be about $515. And this is probably on the low side. So, if you go to, so here we have, this is your charge amount again, right here, this column here. And if you get into a practice that offers a cash or a discounted TOS pricing, you're looking at these prices, which ends up being about $337 for the same visit. So you've already saved 35%. But if you go to a DPC, a direct primary care facility, you've got maybe a $15 office visit, or it could be free. And then all the way down, the EKG's included, chest x-rays included, you've got CBC, troponin, $17 for the CKMB. All of these services are included. So you're looking at $85 or 84% savings on that one office visit. So keep that in mind and multiply that over, if you've got a company of 100 employees, you can see where you can save on claims. So let's look at this 112 enrolled employees again. So we've got the self-funded plan. You've got your claims here of $690,000. And you've got your TPA here of $30,000, stop loss of $130,000, your savings of $120,000 here, and here is your premium paid just for doing self-funded. But then you add in the DPC, all of a sudden your claims on minimum drop to $493,000. Your stop loss is still the $130,000, your TPA is still $30,000, and you're looking at a combined savings. Here's your original $120,000 savings. Now you've got another $197,000 savings from the claims. So you're looking at $317,000 in employer savings just by doing self-funding and adding DPC to it. So you've got a decrease of your premium from $850,000 to $653,000. And then if you compare it to the traditional model, you go from $970,000 to $653,000, or a savings of 33%. So that's a tremendous savings. So what is the solution to this whole problem? Patient, employee, physician, business employer. It's self-funded insurance plus direct primary care. And how do you get started? You find an independent TPA. Your TPA is the most important part in this entire process. A third-party administrator is the one that will sit down with the employer. They actually write the plan with them. They look at risk. They look at past health information on employees to determine what the plan should be. what the cost share is going to be. They do all of that. Then they go further and adjudicate claims. They take care of that whole process. So finding a good independent TPA is important. And I say independent because most third-party administrators tend to lead you down that road of a PPO. They want you to get into a PPO network. The PPO network is not going to allow you the transparency or the ability to contract with a DPC. So that's why I say independent.